Imagine a time machine, not for traveling through time but for testing your trading strategies. That's backtesting. It's like having a crystal ball, letting you see how your trading plan would have fared in the past. This is invaluable because past market behavior can provide clues about the future. Backtesting involves applying your trading rules to historical data. Imagine you have a system that buys stocks when they break out above a 52-week high. Backtesting lets you see how this system would have performed over the last 5 years. This gives you a sense of its potential profitability and risk. Think of backtesting as a dress rehearsal for your trading plan. Before risking real money, you want to practice and refine your strategy. Backtesting lets you do just that, identifying strengths, weaknesses, and areas for improvement. Without backtesting, you're essentially flying blind in the market. It's like setting sail without a map or compass. Backtesting provides the navigational tools you need to navigate the complexities of the financial markets. Backtesting is not just a fancy term thrown around by professional traders, it's the bedrock of successful trading. By analyzing historical data, you gain insights into how your strategy would have performed under different market conditions. Imagine testing a trading strategy that worked flawlessly during a bull market. You might be excited to implement it, but what happens when the market sentiment changes? Backtesting helps you understand how your strategy would react during market downturns or periods of high volatility. This insight is crucial because it allows you to manage risk effectively. By understanding your strategy's potential for losses, you can set appropriate stop-loss levels and avoid catastrophic losses. This knowledge is key to protecting your capital and staying in the game for the long haul. Furthermore, backtesting helps you optimize your trading strategy. By tweaking parameters like entry and exit points, you can fine-tune your approach for maximum profitability. It's like a scientific experiment, allowing you to adjust variables and observe the impact on your results. Just like any other field, the tools and technologies used in trading are constantly evolving. Backtesting in 2025 will require access to advanced platforms and software that can handle the complexities of modern markets. Trading platforms with built-in backtesting capabilities are essential. These platforms provide access to historical data, charting tools, and customizable indicators. Look for platforms that offer a wide range of asset classes, including stocks, futures, forex, and cryptocurrencies. Data is the lifeblood of backtesting, and in 2025, accessing high-quality data will be more critical than ever. Look for data providers that offer accurate and granular data, including tick data for high-frequency testing. Furthermore, consider incorporating artificial intelligence and machine learning tools into your backtesting process. These technologies can help identify complex patterns and relationships in data that humans might miss. Remember, backtesting is only as good as the tools and data you use. Investing in robust and reliable resources will pay dividends in the long run. Alright, let's dive into the step-by-step guide to backtesting success. First, define your trading strategy clearly. This includes entry and exit points, position sizing, and risk management rules. Next, gather historical data relevant to your strategy. Make sure the data is accurate and covers a sufficient time period. Then, apply your trading rules to this data and record the outcomes. Analyze the results to identify patterns, strengths, and weaknesses. Adjust your strategy based on these insights and retest. Finally, keep refining your approach until you achieve consistent and satisfactory results. Remember, backtesting is an ongoing process. The market is always changing, and your strategy should evolve with it. Happy backtesting!